Gary from Revenue Real Estate Education, and this is for the Canadian Real Estate Network, and this is video number 5 of our series. So in this video we're going to talk about calculating ROI, which is the return on investment. Now there is a calculation, and the reason this is important when you're doing ROI is because when you start to raise money for your deals, or when you want to look at how much money you're going to make in your deals, it's very important to use this to assess a property, and you can do it pretty quick. You can look at a property, get a good estimate of where it needs to be and what kind of return you'll get off that property. So it helps you sort through properties very fast, very quickly to get to the ones that are the absolute gems that you need. So the formula for calculating return on investment is your money out divided by your money in. That's going to give you a decimal number. So you multiply that by 100. This gives you a percentage, and then you divide by the number of years, and that'll give you an annual return on investment. So you want to make sure that you're always comparing apples to apples. So that's why we get an annualized return. So if someone says, oh, I got a 20% return, but they did it in 6 months, and someone says, I got a 20% return, but they did it in 2 years, then really the 20% in 2 years is 10%, and the 20% in 6 months is 40. And we'll get into that and explain that through the thing. So first of all, what we want to do is work out the money in on a property. So for this example, we're going to use a basic strategy of a 5-year buy and hold, which means we're going to buy the property, keep a hold of it, rent it out, and we're going to have a purchase price of $300,000. Okay. So we're not doing anything crazy. We're just going to buy a house. There's no creative strategies in this. We're going to buy a house, put a tenant in it, rent it out, manage that property, and then we'll see how this works out in this calculation. So one of the things I would recommend is always have a calculator and always do the math. Even if it's simple, do it in your head and in the calculator. And it's a way of checking yourself to make sure that what you think you should be getting is what you're actually getting. And if there's ever a discrepancy, then it makes you double check something. Because when we're doing numbers, sometimes you have a tendency to push the wrong button or to, think you might make a mistake in your head. So money in on $300,000 on a rental property, you've typically got to put 20% down. So you need to calculate your 20% down payment for $300,000. So $300,000, depending on the calculator you've done, you can go times 20% or times 0.2. That'll give you 20%, which is $60,000. So now we have numbers that we can start to put into this money in. So we have $60,000 as a down payment. Now here in British Columbia, there's a transfer tax. So the transfer tax on a $300,000 properties is 1%. It's actually, when I looked online, it's about $2,900, but let's round it up and go $3,000. And closing costs on this kind of property. Now, these are questions you can ask your notary, your lawyer, whoever you're using, but roughly you're probably looking at about $1,500 there for closing costs. I've got this from a little bit of experience now. We kind of know roughly because we've done enough properties, we know what our closing costs are. But if you're not sure, go and ask your notary, ask your realtor even how much they ask people in your team. So there's a total there that we got to put in here. So 63, so we're going to, remember, do the math. I'm expecting 64.5. So let's check on that. 3,000 plus 60,000 plus 1,500. See, it didn't come up on my calculator. So double check. 60,000 plus 3,000 plus 1,500. 64,500. So now there's 2 checkpoints there that we've done. So 64,500. That is your total money in. Now there are some optional things that will go in on your money in. So things like if you're doing repairs, upgrades, renovations, carrying costs, if it's going to be empty while you're carrying it and you do the renovations. So again, these are optionals, but we're doing a very basic, we're buying a house, it's already got a tenant, or the tenant's going to go in pretty much straight away, so we're not factoring this into it. But you want to make sure that if you are doing renovations, you are doing repairs, upgrades, if you put new things, you got to put all those numbers onto this as well. So money in. So our money in for this example is $64,500. Now that's an expense to buy this property. So now we want to do the fun stuff, the money out. How much are we going to get out of this property? So now we said it's a pretty, standard buy and hold. We're not going to get too crazy on this. we're going to say that the cash flow, now cash flow is the money that you have left after all of your bills are paid. So that's your mortgage, your insurance, your utilities, your taxes. You also want to factor into that the vacancy rate. So you want to put about 8% of your total income into that pot. So when you do get a vacancy, because you will at some point, the money's already there. It's not a stress in your life. You want to be hassle-free when you're doing these properties. You also want to put in a maintenance, and you want to build a kitty up in this maintenance fund. So allow a percentage for maintenance. So we do, depend on the quality of the property, we do about 5% of the collected rent, and we put in as maintenance. So cash flow, let's say after all those bills are paid, we're not going to go crazy, you're only going to have $100 profit a month. So cash flow monthly is $100. We're also going, now we're doing it over 5 years, we said, right? 5 years buy and hold. So that's $100 a month, which is $1,200 a year. So 100, like I said, do all your math to check, 1,200, then you're going to times that by 5 years. So $6,000 over the 5 years you will get in cash flow on this house. Now, mortgage pay down. So the mortgage pay down is somewhere between, on these numbers, is between $7,000 and $9,000, depending on your term, depending on your interest rate and stuff like that. If you want to find that out, you can go to any bank or lender, you can put in the mortgage amount, the interest rate, the time frame and all that, and it will give you a sheet that will tell you every month how much principal you will pay down. So we're going to go on the low end of that, just for this calculation, and go 7,000 divided by 12. So the monthly is 583 times 12, and we're going to do that over 5 years. So that's $35,000. Now, market appreciation. This is where some people get carried away and they expect the market to do what it's been doing for the last 1 or 2 years. And there are ways to look at what's happening in a market. But for this, we want to be really conservative. So we're going to go 3%. So 3% of 300,000. So 300,000 times 0.03. That'll give you your 3% per year. So at 3% a year is 9,000. But remember, we're doing this over 5 years, so times 5, $45,000 over the term. So 45,000. So now we're going to total all those up for our total money out. So 45,000 plus 35,000 plus 6,000. So that gives us $86,000 total out. So now that is our money out. So we can now put this into the money out equation. So we go up here. Money out, $86,000. So now, through the calculator, 86,000 divided by 64,500 equals 1.33. Now we multiply that by 100 to give us a percentage. 133.33. Now we divide this by the number of years to get the annualized return that we discussed. So our number of years was 5. And that's going to give us the annual ROI. So divided by 5. 26.6% ROI. Now, this is where, when you're doing these calculations, especially if you are looking to raise money to buy your properties, let's say you're looking to raise capital and you're getting someone, this is where you can take these numbers, look at it, and say, okay, you know what, I want to go in a joint venture deal. Now, however you split that deal, there are some joint venture videos we can look at and go over, but let's say you're going to go 50-50. So now we're going to change these numbers, right? Because we're collecting 40,000, but this is what you would show your joint venture partner on a piece of paper. Because they want to know how much money they're going to make. If someone's going to give you a chunk of cash, let's say they're going to give you all of this money, 64,000, they want to know how much they're going to get back. So let's say you're 50-50, so 86, so half of that is 43,000. Now, we're going to go through that same process, but we're going to use this lower number. So 43,000 divided by 64,500 equals 0.66, well, 0.67. And then we times it by 100, 66.67. And then we're going to divide it by the number of years, 13.33% annualized return. 0.33. So now, this is why it's important to calculate ROI, put in your expenses. There are also other options you can get on income, like if you're buying a house and you're going to do renos and force appreciation and create equity in it, if you're going to buy below market value, let's say you get a motivated seller and you get below market value, then that all becomes money that comes out of this. So it'll affect this number here. Now imagine if you could walk up to somebody and say, hey, here's the return on the investment. What are you currently getting? Ask them to look at the 5-year average from wherever they've got it in mutual funds and stuff like that. And then you can show them on paper very simply, hey, look at this kind of ROI. Would you like to get 13, 14, 15, 16% ROI on your investments? If they say yes, now you've got a joint venture partner that's going to help you buy this house. You can manage this property or have it managed professionally, and then you're going to get a return on that money. That's why return on investment is one of the most important things to calculate when you're figuring out what house to buy and also when you're looking to raise capital from joint venture partners. That's video 5. We'll see you in the next one. I'm Gary Spencer Smith from Revenue Real Estate Education, and this is for the Canadian Real Estate Network. See you next time.